If I put money into life insurance, why the heck would I have to pay interest to borrow it back? That sounds like an absolute scam, right? But what if I told you paying interest is actually the secret to building wealth that you can use and grow at the exact same time? My name is Devin Burr. Stick with me and I'll show you how the wealthiest families and individuals have used this exact concept for over 100 years and how you can as well. We're talking about infinite banking. This is funding a specially designed and engineered whole life insurance policy. This isn't your grandma's policy. It's not a policy your broke-ass brother-in-law is trying to sell you. This is one that is optimized for maximum cash value, not just for a death benefit to your family when you pass away. Think of it like this. You put money into this policy, it compounds and grows tax-free, guaranteed. So then you have an ever-increasing pile of money that you can borrow against when you need it. So here's the thing. When you borrow money from a policy, you're not actually borrowing money out of that policy. That's not what's happening. You're actually borrowing from the insurance company. They're using your policy as collateral. That means that all of your money that you put into your policy is still compounding and growing and earning dividends like you never touched it. This is called uninterrupted compound growth. And it's the opposite of if you put money into a savings or checking account. If you use that money, you stop earning what the bank pays you. On average, it's 0.06%. So it's almost nothing. But in a policy, you get around 5 to 6% growth tax-free once you add in dividends. So you're getting that growth even though you're using money to go become your own bank. You do pay interest on the loan. And here's why that's a good thing. Because you're not actually using your money. You're borrowing the insurance companies. Yours is sitting in your policy, compounding and growing. So let's say you put $50,000 into a secure account. That account is growing and compounding. You borrow $25,000 against it. Your $50,000 is still compounding and growing, but you take the $25,000 and go make more money with it. I'll give you a real life example. Let's say you fund a policy with $20,000. Your cash value, let's say, is $18,000. What you're going to do is you're going to borrow against that cash value. You're going to borrow the insurance company's money, and let's say that's at 5%. You're going to take that borrowed money. Let's say you go do a private money deal at 12% interest. That money is out working for you for 1 year. That means that it's going to make you $2,160, but you only had to pay $900 to control the money. Basically, what you're doing is you're making an arbitrage on money. Banks do this all the time. You're making more than what it cost you to control the money. The whole time you're doing this, your policy is still compounding and growing at about 5 to 6% tax-free. Why do I have to pay interest? That's the wrong question. The right question is, what do I get for paying interest? Check this out. With a policy, all the values grow 100% tax-free. Policies predate the tax code. Tax code came around in 1913. Policies started back in the 1700s. They have stood the test of time. You also get uninterrupted compounding. Einstein said it best. Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. If you give compound interest time to do its thing, it becomes a huge, huge amount of money over time. You also get protection against lawsuits and judgments. You see, it's a private contract between you and the insurance company, so nobody can touch the money except for you. You also get instant liquidity. It's not like with a 401k or an IRA where you have to put money in and wait 10, 15, 20 years until you're 59 and a half to use the money with no penalty. With this, as long as it's structured properly, you put money in, you can use that cash value immediately in the first 30 days. Also, there's no credit checks required. It's the easiest loan you'll ever get. You don't have to check your credit. You don't have to submit financial statements. You just simply say how much you want and what bank account you want it to go to. It's that easy. Also, You have the ability to make money in multiple places at the same time when you use this concept. It's incredible. You get profitability from when you pay interest. What do I mean by that? When you pay interest to the insurance company, it's helping them become more profitable. It's a mutually owned company. Those are the companies we use for infinite banking. That means that you're a part owner of that business. When they're profitable, you're profitable. They pay a dividend every single year based on how profitable they were the year prior. These companies we use have paid dividends every single year for over 140 years. That's through the World War, World War I, World War II, the Civil War, the Great Depression, meltdown in '08, swine flu, bird flu. It doesn't matter what's going on in the world. These insurance companies are still profitable. And when they're profitable, you get a dividend. Last thing is, there's no repayment terms required. What do I mean by that? When you borrow from an insurance policy, you never have to pay that loan back. You never have to pay the interest. You should. It's part of a strategy. It's part of the infinite banking concept of moving money, but you never have to pay it back. You see, when you're borrowing from the insurance company, you're borrowing your future death benefit. They guarantee two things. Life insurance companies guarantee two things. One, they guarantee that your money will compound and grow at a certain interest rate, guaranteed. The second thing is they're guaranteeing when you pass away at some point in the future, your family will get a tax-free death benefit. So, since that's an inevitable thing to happen in the future, all they're doing is they're just letting you borrow that future death benefit while you're alive. The cash value is the equity that you've built up with that death benefit. So you're just borrowing that. If you never pay it back, which again, you never have to, they'll just simply deduct it from the death benefit when you pass away. They know it's going to happen. So they'll never ask you to make a payment. They'll never ask you for an amount of interest. It's never something you have to pay. It's something you should pay because of all of these things that I just described. Let's bust a few myths real quick. First myth I hear all the time is it's a scam. No, it's been around for a very long time. The wealthiest families and individuals have used this for over a century. Banks use it. You can research BOLI, bank-owned life insurance. Banks own billions upon billions upon billions of dollars of properly structured whole life insurance. They literally own more life insurance than all of their buildings and the land that they owned combined. So no, it is not a scam. You're losing money when you pay interest. That's not accurate. You see, if you're using the actual borrowed money correctly with the infinite banking concept, you're actually borrowing, having your money compound and grow, use that borrowed money to simply make more than what it costs you to borrow. If it costs you 5 and you go make 10, you just made a 5% spread while your money continued to compound and grow. If you take a policy loan and pay a debt off, let's say a debt that you were paying 20% interest on, a credit card. If you simply take what those credit card payments were and pay it back to your policy and recapture the money, you're actually recapturing 20% interest that you used to give away. The whole time, your money's compounding and growing. So no, you are not losing money by borrowing it. The last thing I get all the time is only rich people should do this. It's only for the rich and the wealthy. That's not accurate. Guys, I have clients that have done as little as $200 a month into a policy. I've also got clients that have done several $100,000. So it's tailor-made for anybody. It's all about where you're at in your life and how you can actually use it to become more wealthy. The more wealthy you become, the more you can do. So yes, you pay interest, but it's by design. You see, it's a way for you to be able to have your money compound and grow while you keep it in motion at the same time. In order for money to really accelerate, it's got to be in motion. It's called the velocity of money. The more times you can move money into different things, the more it's going to grow. So this gives you the ability to do that while also taking advantage of steady eddy compound growth that is tax-free. If you got value from this video, make sure to hit the like button. If you've not subscribed to my channel, make sure to do that. Hit the bell so you get notified when I put out all these videos, and throw your questions in the comment section. I will make sure to get back to all of them. If you are ready to start your own infinite banking policy, there's a link in the description. Go ahead and check that out, and we will help you get on your way to financial freedom using infinite banking.